Interest rate decisions are usually covered as distant macroeconomic news. A number moves, markets react for a day, then the conversation moves on. But for anyone building, investing in, or working inside the artificial intelligence sector, the Federal Reserve's rate path is one of the most consequential variables in the room, and it rarely gets analyzed with the seriousness it deserves. This video breaks down exactly how monetary policy moves through the AI funding pipeline, why the effect is more pronounced in AI than in most other sectors, and what founders, operators, and investors should actually be watching for. Start with a basic fact about how AI companies are built. Training large models, securing compute capacity, and hiring scarce technical talent all require sustained capital, often for years before a company produces meaningful revenue. Unlike a traditional software business that might reach profitability on a modest raise, frontier AI development is closer to biotech or semiconductor manufacturing in its capital intensity, enormous upfront spend, a long runway to return. That capital comes overwhelmingly from venture capital, growth equity, and, increasingly, strategic investment from the largest technology companies. All three sources are sensitive to the cost of capital, though in different ways. Venture capital funds raise money from limited partners, pension funds, endowments, family offices, who are comparing the expected return of a venture fund against the return available from safer instruments like government bonds. When the Federal Reserve raises interest rates, the yield on those safer instruments rises. That means the venture fund needs to clear a higher bar to justify the risk of a speculative bet, which in turn makes fund managers more selective and pushes them to demand better terms, lower valuations, clearer paths to revenue, more investor protections before deploying capital into an AI startup. Growth equity investors, who write larger checks into more mature but still scaling companies, respond similarly but with more emphasis on near-term revenue multiples, since their thesis usually depends on a company reaching an exit, acquisition, or IPO within a defined window. Higher rates lengthen the perceived time to exit and compress the multiples investors are willing to pay today for tomorrow's revenue. Strategic investment from large technology companies is somewhat more insulated, since those companies are often funding acquisitions from existing cash reserves rather than raising new capital. This is precisely why higher rate periods tend to favor consolidation. Well-capitalized incumbents can acquire promising but funding-starved AI startups at valuations far below what those startups might have commanded 18 months earlier, when capital was cheap and abundant. Looking at recent tightening and easing cycles, a consistent pattern emerges. Early and seed-stage AI companies are affected first and most severely during tightening because they have the least revenue to point to, the longest runway before profitability, and the highest dependency on continued external funding to survive. Later-stage revenue-generating AI companies feel the effect with a lag, but it does arrive, often through down rounds, extended fundraising timelines, or a shift in investor priorities from growth at all costs to demonstrated unit economics. When the Fed signals an easing cycle, holding rates steady after a period of increases or actively cutting, the dynamic reverses often faster than fundamentals would suggest is warranted. Capital that had been parked in safer, higher-yielding instruments begins searching for growth again, and AI, as the sector generating the most investor and public enthusiasm, tends to be first in line to absorb it. Valuations expand rapidly. Competition for a limited pool of qualified machine learning engineers and researchers intensifies, pushing compensation packages higher across the sector. IPO windows that had effectively been closed during the tightening period begin to reopen as public market investors regain appetite for growth-stage technology listings. This is not a phenomenon unique to artificial intelligence. Every capital-intensive, pre-profit sector has moved through comparable cycles, from biotechnology to clean energy. What distinguishes the current AI cycle is the sheer scale of capital involved and the speed at which sentiment shifts, amplified by how closely every major AI announcement is covered across both financial and mainstream media, creating feedback loops that can accelerate both the expansion and contraction phases. For founders, this means fundraising strategy cannot be separated from the prevailing rate environment. Raising during a tightening cycle demands a fundamentally different pitch than raising during an easing cycle. Investors in a higher rate environment want to see a credible path to unit economics, defensible technical or data moats, and realistic burn projections. The growth at all costs narrative that works well when capital is cheap tends to fall flat when investors have safer, higher-yielding alternatives. This also affects hiring and product strategy. A founder who raised a large round during an easing cycle, then faces a tightening cycle at their next raise, often needs to extend runway through headcount reductions or slower product expansion, decisions that look from the outside disconnected from product performance, but are in fact a direct response to the shifted cost of capital. For operators inside larger AI companies, understanding this cycle explains hiring freezes, reorganizations, and shifting internal priorities that can otherwise seem arbitrary. Leadership decisions that appear reactive to short-term news are frequently anticipatory responses to where the funding environment is heading over the following 12 to 18 months. For investors, whether allocating venture capital directly or simply tracking the sector as an informed observer, the practical implication is that valuation multiples in AI should never be read in isolation. A given multiple that looks reasonable in an easing cycle may be significantly overextended once rates rise, and a multiple that looks conservative during a tightening cycle may represent genuine undervaluation once the cycle turns. Reading sector valuations alongside the rate environment, rather than as a standalone data point, is a discipline that separates informed capital from momentum-driven capital. The broader takeaway extends beyond any single rate decision. Whoever you are in this ecosystem, founder, operator, or investor, the Federal Reserve's rate path deserves the same ongoing attention on your calendar as your closest competitor's product roadmap. It is shaping the funding, hiring, and valuation environment you operate in more consistently than most decisions made inside any single AI company. This analysis is for informational and educational purposes, drawn from public reporting, shipping data providers, and government sources. It is not investment, legal, or policy advice. This is the Katakyie Brief. While everyone talks about the military side of geopolitics, we track the boardrooms, the balance sheets, and the breakthroughs that quietly redraw the map, because the next war for power won't just be fought with weapons, it'll be fought with technology, capital, and ideas. If you want to stay ahead of that shift, subscribe, share this with someone building in the space, and follow for the next brief. Stay sharp, stay ahead. This is the Katakyie Brief.